Hey Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, we're going to go over those rates on the Market Watch calendar here, where we did see the PPI inflation rate was pretty much almost twice as heavy as expected, which has sent markets into a flurry. Guys, that does just put a little damper on the expectations for rate cuts later this year. Sooner, it does suggest that maybe rate cuts may come later, and of course that affects liquidity, so markets just don't really like that. Tomorrow we do have the CPI data, which is another measure of inflation, and CPI does tend to follow PPI, at least in terms of data, and so that does suggest that they're probably going to go hand in hand. However, a lower reading on the CPI could be favorable for the markets, so you do want to be aware of that. As for now, we can see that if we just take a look at this historical range for CPI and PPI, we are finally back in kind of a normalized region here in this kind of box that I've drawn out for this historical range ever since the 1950s, where this is pretty much where the market lives, okay? And so markets are just saying, well, now that we're in this normalized range, maybe it's time for those interest rates to come back. However, you can see that we are kind of on the upper half of this range, and that is where we can see some of these double spikes or just some type of spikes just popping out of this chart pretty hard. Of course, we don't want to go back to this. Now, what happened to cause that spike, of course, was back in the Trump administration. He was basically pushing the Federal Reserve to cut interest rates as much as possible. So the Fed really had no ammo to fight hyperinflation when the markets started to print all of this money. Basically, all the governments around the world, as well as the United States, they just started to print money just to deal with the COVID thing. And unfortunately, a large portion of that was earmarked during the Trump administration. It finished to the end of his term and continued about a year into Biden's term. That's when the Federal Reserve had to be renewed. So about a year into Biden's term, as a condition on the renewal of Jerome Powell's position at the Federal Reserve, he said, no, you have to stop doing this money printing that was happening during the Trump administration, and you have to change that policy into tightening. That's why right here in 2022, you see this sudden and sharp reversal, because that was a condition of Jerome Powell holding his job. Of course, this helped pump markets during that election year, which of course Trump did lose, and Biden basically enjoyed the tail of that money printing kind of escapade that Jerome Powell went on based upon the former policy. Of course, no politician is going to reject free money, but once we did see that we were basically starting to enter this kind of hyperinflation risk zone, then of course it was forced on Biden, right? None of these guys are the good guy here, right? It was forced upon him that he must change that policy, and so absolutely he did. And to his credit, inflation has come down dramatically. You can see it actually in the charts here. It is very consistent with these type of reversals that we've seen in the past. So that does mean that we are on the right track. The problem is, of course, that we are in this upper bounds of that kind of normal range historically, and that's where we can see these double poking out of that box, right? This kind of normal, this kind of risk of inflation coming back, right? And so we have to just play whack-a-mole, and we have to just continue to push that inflation down more to the middle of the range solidly, where we can live pretty peacefully for maybe 10 years at a time. And I think what markets are just having to come to terms with is that they're going to have to live with a normal range of inflation and a normal level of interest rates, not these 0% interest rates and not just very little inflation, as the world had been continuously expanding during the internet boom and during hyper globalizations, right? Where just markets were expanding, expanding, expanding. Now we're entering into a period where markets are contracting as we're trying to get away from Russia, trying to get away from the Chinese Communist Party. All of these things are just kind of leveling off globalization. And then, of course, with the rise of inflation, of course, interest rates have to come up, right? And so we don't have this feeling of continuous stimulus. It's kind of like we were cocaine addicts ever since basically the beginning of the 2000s, when markets were just in expansion ever since, basically. The Clinton administration, times were pretty good, right? But of course, that was mostly a function of the internet and globalization. And that has just come to a screeching halt at that point of COVID, where all markets essentially shut down. And then, of course, the government just continued to do what it was doing in the past, and it just no longer worked that way, okay? Things had to change. And so now we're going back to kind of a normalization type of era where we have to do things a little bit more like they were done in the past. And we're just going to be playing whack-a-mole, as markets are not going to be continuously expanding forever. And there are some upper bounds on the economy finally. And yeah, I mean, the market has to come to terms with this. It has to decide that it is willing to live with normal interest rates, right? On a historical level, just these are normal interest rates, not like 0% interest rates, right? They're normal interest rates corresponding with normal levels of inflation. And that's something that the markets are just reluctant to do, because they have already priced in this kind of infinite kind of expansion model. And so a lot of things are starting to break. This is not an easy problem to solve. And it's not just government debt, it's also private debt and how people are spending on their credit cards. It's also how foreign banks are kind of issuing loans using dollars, et cetera, et cetera. And so this is a very complex situation that we're in. It's not going to get solved overnight. And so just interest rates being a little bit higher for longer. Again, guys, you just have to understand, like, we're just trying to get ourselves into this solid normal range, and that's what's going on there. If we do take a look at the BTC chart, you can see that this was the previous pool that I gave you. I said that we needed to flip it. Of course, we flipped it, and so that is quite a good outcome there. If I do give some updates for you, you can see this becomes our new kind of ambiguous range, and really we want to get above 62,930-ish, and then we do show some strength of the move above 63,615. Where does this start to fall apart? Not really until under 59,000. So we do have room to maybe even take a little bit of a dip here, okay, guys, without any too much concern. But under 59,000, this bullish divergence would start to disappear. And so, of course, we want to hold above that, because this does suggest that we can have possibly this breakout. We don't want to be breaking down into this bear zone, guys. If we do just take a look at Solana really quick, essentially Solana is unchanged from the last time that we looked at it. We do have a bit of this engulfing candle here. Now, I did say that we were in a position that was more likely for shorts, just being that we were at the high here. And if this thing does just come screaming down, just understand that's what it's done in the past. And so, before it has a breakout, it can also just come back to its lows. And, conceptually, what could this be? Well, maybe it could be something like this, right? And we still have that inverted head and shoulders kind of formation going on. So if we do have a dip, I'm not really too concerned about it. Where do I get concerned? Maybe under 125-ish, okay? Then we're going to be taking out this low pretty significantly over here. So I would say 125, we want to stay above that. And then where do I get really bullish on this thing? Well, above 150. If we flip the neckline of this inverted head and shoulder, then 150 would start to look pretty good to me. All right, guys, that's your alpha for the day. Stay safe and happy trading.